In this video lesson, we'll be discussing imbalances and the market on close orders used to participate in them. First, MOCs, which stand for market on close orders, are orders requesting to be executed on a stock at the closing price of the trading day. These buy or sell MOC orders can be entered at any time during the trading day in any stock, but can only be canceled before 3:45 p.m. After 3:45 p.m., MOC orders are only accepted for stocks with imbalances. Furthermore, all MOC orders submitted after 3:45 p.m. and before 4 p.m. are final and will be executed at the closing price that day. Thus, during that time frame, you cannot cancel or change your MOC order once you have submitted it to the exchange. Moreover, similar to other day orders, any MOC orders submitted at or after 4 p.m. are rejected and will not be executed. Okay, so what exactly are these MOC orders used for? Well, often large traders, investors, hedge funds, or even institutions decide to enter or exit a stock on the closing print of the trading day rather than during market hours. The exact reasons for doing so vary, but often have to deal with the overall ease and assurance that a legitimate attempt will be made to execute their orders at a fair price. When these large MOC orders are sent during the trading day, they create pools of orders, often causing bias in one direction or another in a particular stock. This abundance of orders all in one direction seeking to be executed at the closing price of the trading day is called an imbalance. Each trading day at 3:45 p.m., every stock on the New York Stock Exchange with an order imbalance is mandated to report this information to the public, while NASDAQ stocks, futures, and ETFs do not participate in imbalances such as this. Once these imbalances are released, they often greatly impact stocks as a wave of new information floods the market. Each stock with such an imbalance will report whether it is a buy or sell imbalance, along with the exact quantity of the imbalance. Now, trading actively takes place over the next 15 minutes as traders speculate on how much of an effect the imbalance will have on the closing price of the stock. Once these imbalances are reported at 3:45 p.m., they continue to re-report every 15 to 30 seconds after that, all the way to the close at 4 p.m. These re-reports update how much of an imbalance remains in each of the equities. Traders then use this information as a gauge to determine how likely an equity is to filling the entire imbalance by the close. For instance, if there is a small chance a buy imbalance of 1,500,000 shares in MetLife, ticker symbol MET, is going to be completed by the close, it then can be expected that the stock will move sharply up in price as traders speculate off this information. However, if the imbalance is expected to be completely filled, then no major action will likely take place in the stock. Moreover, as like with the rest of the trading day, the overall market direction will greatly impact the stock and its likelihood of an imbalance being filled by the close. If the overall market significantly declines from 3:45 p.m. to 4 p.m., most, if not all, buy imbalances will most likely decrease, regardless of the imbalance. Inversely, if the overall market ascends from 3:45 to 4 p.m., most, if not all, buy imbalances will most likely rise, even if an imbalance is most likely satisfied. Additionally, even though a stock has fallen from 3:45 to 4 p.m. due to overall market activity, the market on close print, which is the actual final print of the day, still may be slightly or sometimes even substantially higher as the imbalance is adjusted at the close. The lure of the market on close imbalance is simple. The greater the percentage of the imbalance at the close for a particular stock, the greater a stock will have to adjust its closing price from its final prints during market hours. If there is a large buy imbalance in a particular stock at the close that is not satisfied, then it is fair to expect a closing print higher than its final prints during market hours. The exact opposite occurs when there is a large sell imbalance in a particular stock that is not satisfied by the close. It is then fair to expect that the closing print will be lower than its final prints during market hours. These closing prints, due to market imbalances, can adjust a stock's price as little as a few cents to sometimes, in very rare cases, as much as a couple of points. The wide-ranging final adjustments that occur are caused by the remaining balance left at the close having to be filled. These imbalances sometimes stay quite large, even after 15 minutes of market speculation, thus causing the remaining shares of the imbalance to be clumped together as one large unified market order that is executed in one final print for the day. Thus, if an imbalance is not married off and evenly matched, at least to some degree by 4 p.m., then a dramatic shift in price can occur. Depending on the depth and thickness of a particular stock's liquidity, will ultimately determine how big of a discrepancy the closing price will be from its final prints during market hours. Okay, so how do you trade imbalances using these MOC orders? Well, almost all advanced trading platforms have access to some sort of MOC imbalance window. Make sure to locate and open your MOC imbalance window slightly before 3:45 p.m. in order to view the imbalances for that trading day. This is what an example of an MOC imbalance list looks like, slightly after 3:45 p.m. Notice how there are numerous stocks listed with various size imbalances, some with buy imbalances and others with sell imbalances. At 3:45 p.m., when all the imbalances have reported, sort all stock imbalances by quantity and quickly scan the list for stocks. Try to identify any stocks with an imbalance that is more than 10% of the stock's volume for that trading day. The greater the percentage of the imbalance, the more likely the stock will move. Once you've identified the significant imbalances, there are two common ways in order to trade them besides simply scalping the volatile moves. The first is to enter the stock soon after the stock reports an imbalance at 3:45 p.m., looking to lock in a great price close to the price the stock was trading at pre-imbalance. This is extremely hard to do though, because there are numerous automated trading systems out there designed to instantly enter into imbalances the exact moment the stock reports, thus causing a spike in price. But if you do manage to enter at a price close to the price the stock was trading at pre-imbalance, then you could look to hold on to the position until the close and enter an MOC order. The second and more common way to participate in the imbalance is to wait until after the initial spike to participate. The advantage to waiting is simple. All of the automated trading platforms, as well as many manual traders, jump in the very second the imbalances report, causing quick and often unsustainable spikes. After a few minutes, the overall market takes a hold of the stocks and help give a better picture of whether stocks will drift higher or lower into the close. Therefore, you can make an educated decision on whether you wish to participate in the imbalances and can discern a fair price of entry. Obviously, the main disadvantage to waiting is that you run the risk of having the stock make a significant spike and never chasing, thus causing you to chase and enter at a possibly overextended price. This is why there are traders who enter immediately and others who choose to wait, because there are clear advantages and disadvantages associated with each. Whether you enter immediately into a stock with imbalance or choose to wait for a better entry point, once in the position, if you feel that there is still a significant imbalance left on a stock or a group of stocks going into the close and want to send an MOC order or orders, Simply change your order type on your level 1 or level 2 window to market MOC. Keep in mind, you can only send MOC orders in the opposite direction of the imbalance. So only sell MOC orders are accepted on buy imbalances, and only buy MOC orders are accepted on sell imbalances. Furthermore, remember that once you have sent that MOC order, you cannot cancel it. Therefore, it is best to wait until the final few minutes of the trading day before submitting your order. Also, it is important to make note that all MOC orders must be routed to the NYSE. ECNs such as ARCA and NASD will reject them. Now, once you have entered the MOC order, wait a minute or two until after the market closes to see what your execution price will be. The final print of the day will be a large block print which contains your order. The final print always takes place after 4 p.m. and can print as soon as within the first minute after the close, or take as long as 10 to 15 minutes, depending on the discrepancy of the imbalance. Keep in mind that, like all trading strategies and setups, there are no guarantees. Even the biggest imbalance can reverse and print adversely. Adverse prints typically occur because too many traders participate in the imbalance, causing the imbalance to flip. For example, if Dean Foods, ticker symbol DF, has a 750,000 share buy imbalance and more than 750,000 shares are bought, speculating on a favorable closing print, let's say 1 million shares, for instance, then the stock will most likely make a sharp run up as the flood of buy orders come in before the closing print. However, if and when all of those buyers exit, if most or all of them exit by using a sell market on close order, then the outcome will most likely be disastrous. This is because the imbalance is no longer 750,000 shares to buy, but instead 250,000 shares to sell. Therefore, the final print will most likely be lower due to the specialist having to lower the price to fill the large sell imbalance. Always assess how much activity has taken place in a particular stock since the imbalance was reported at 3:45 p.m., as too much activity will reverse the imbalance. Remember to trade intellectually and carefully when participating in stocks with imbalances due to the volatility and unpredictability associated with them. Make sure not to stray from your game plan and adhere to the rules when participating in imbalances. Ultimately, you will find that imbalances are best on high volume, higher volatility trading days. That is when more imbalances flood in and report at 3:45 p.m., which in turn make it nearly impossible for all the imbalances to be satisfied in time for the close. Therefore, when there are less than 200 imbalances overall on the day, most, if not all, of the imbalances will most likely be satisfied. However, when that number rises to over 300, 400, even sometimes 500 stocks with imbalances, it then becomes difficult for all of them to be successfully fulfilled, thus creating the possibility of some significant moves. Now, all of this information provides a great starting point for trading imbalances, but you will find that as you get more comfortable with imbalances, you will develop more comprehensive ways to identify and participate in closing trades for the day.